All right, let's jump right in. If you're prepping for your qualifying exam, this is one of those papers you absolutely have to know inside and out. We're going to break down Jensen and Meckling's theory of the firm piece by piece so you're ready to nail any question that comes your way. Okay, so here's our game plan. We'll start with the big puzzle they're trying to solve. Then we'll get a solid definition of the agency problem. After that, we'll dive into the two big costs, one for equity, one for debt. Then we'll put it all together to see how firms find their optimal structure, and we'll finish up with the absolute must-know takeaways for your exam. Think of this as your study guide. So, first things first, we got to understand the world before this paper. What's the fundamental question Jensen and Meckling are actually trying to answer here? What is a firm, and why is it so full of inherent conflicts? You know, this core issue isn't exactly new. We're talking centuries ago. Adam Smith himself pointed out this exact problem. He basically said, when you have managers looking after other people's money, there's no way they're going to be as careful as if it were their own. This is the classic separation of ownership and control. For a long time, economics just treated the firm as a black box. Inputs go in, profits come out, and its only goal is to maximize those profits. But what Jensen and Meckling did was revolutionary. They blew that black box wide open. They said, no, a firm isn't a thing at all. It's just a legal fiction. Really, it's a nexus of contracts between a bunch of different self-interested people. That one shift in thinking changes everything. So if the firm is just a big web of contracts, that leads us directly to the absolute heart of the paper, the agency relationship and all the costs that come with it. So what is an agency relationship? It's simple, really. Anytime a principal, say a shareholder, hires an agent, like a manager, to do a job for them, that's an agency relationship. And here's the rub. If we assume both the principal and the agent are just trying to maximize their own happiness, there's absolutely no reason to think the agent will always do its best for the principal. Their interests are bound to diverge. Okay, this is absolutely crucial for the exam. The total agency cost isn't just one number. It's the sum of three distinct parts. First, you've got monitoring costs. That's the money the principal spends to keep an eye on the agent. Second, there are bonding costs. This is what the agent spends to prove they're trustworthy. And third, and this is the killer, is the residual loss. That's the value that gets destroyed anyway, because you can never get perfect alignment. All right, let's get into the first big part of the model. This is the classic scenario they walk through. What happens when an entrepreneur who runs their own company decides to sell off some stock to outside investors? Think about it like this. If you own 100% of your company, every single dollar you waste on something for yourself is a dollar straight out of your own pocket. But now imagine you sell half the company to someone else. That same dollar you spend on, say, a fancier office only costs you 50 cents. The other 50 cents is now coming out of your new partner's pocket. See the problem? The incentive to splurge just got a lot stronger. And this is where we get the idea of perquisites, or perks. We're talking about all the on-the-job consumption that makes the manager's life better but doesn't help the firm's bottom line. The ridiculously plush office, the corporate jet you don't really need, a bloated staff, anything that burns the firm's cash to increase the manager's personal happiness. Now, we can actually model this. For a 100% owner, the trade-off is perfectly clean. For every dollar of perks they consume, the firm's value drops by exactly $1. On a graph, that's a budget constraint with a slope of -1. It's a straight one-for-one deal. But watch what happens when they sell stock. The manager's personal price for buying a dollar's worth of perks just went down. Since they don't bear the full cost anymore, that budget line on the graph rotates. It gets flatter. And what does any rational person do when something gets cheaper? They buy more of it. So the manager consumes more perks, and the final value of the firm ends up lower than it could have been. Okay, so here is the million-dollar question, and I promise you, this is a classic exam question. Who actually ends up paying for all these extra perks? You might think it's the new shareholders who bought the stock, right? Nope, and this is the pure genius of the paper. Jensen and Meckling argue that the market isn't stupid. Rational investors can see this coming from a mile away. They know the manager now has an incentive to misbehave. So what do? They pay less for the shares in the first place. They discount the price today to account for the value they expect to be destroyed tomorrow. And because of that, the original owner-manager bears 100% of the economic cost. So that's the problem with equity. You might be thinking, easy, let's just finance the firm with debt and avoid this whole perk problem. Well, not so fast.
Using debt doesn't eliminate agency problems, it just swaps them out for a completely different and equally dangerous set of issues.
When a firm has a lot of debt, the equity starts to look a lot like a call option. Think about it. The shareholders have unlimited upside if things go great, but their downside is capped. They can only lose what they put in. This creates a nasty incentive to risk shift. Managers, acting on behalf of shareholders, now want to swing for the fences with super risky projects. If the bet pays off, shareholders get all the winnings. If it blows up, well, that's the bondholders' problem. And just like before, these agency costs of debt come in 3 flavors. 1, the value you lose just by making these dumb, overly risky investment decisions. 2, all the monitoring costs to try and prevent that behavior. Think of all the restrictive covenants and rules written into debt contracts. And 3, if the gamble fails, you've got the very real, very expensive mess of bankruptcy costs. Okay, this is where it all comes together. We've seen the problem with too much outside equity, and we've seen the problem with too much debt. Now, let's put them both on the scales and see how a firm finds the right balance. What the firm faces is this fundamental trade-off. If you rely too much on outside equity, you're going to have a problem with managers consuming perks. But if you rely too much on debt, you're going to have a problem with managers gambling with the firm's assets. You're caught between a rock and a hard place. And this leads us to the big capstone graph of the whole paper. As you use more outside equity, the agency costs of equity go up. As you use more debt, the agency costs of debt go up. So when you add those 2 curves together, what you get is this U-shaped curve for the total agency cost. And the main punchline is this. A firm's optimal capital structure, that perfect mix of debt and equity, isn't some magic number. It's simply the point at the very bottom of that U-shaped curve. It's the combination of financing that minimizes the total damage from both of these agency problems combined. Okay, let's wrap this up and boil it all down. If you're cramming for the exam and you can only remember a few things from this paper, make it these 3 core contributions. Number 1, they totally redefined the firm. They threw out the old black box idea and gave us the nexus of contracts, which is the foundation for almost all modern corporate finance. Number 2, they gave us a powerful theory of capital structure based on trading off the agency costs of equity against the agency costs of debt. And number 3, they showed us who really pays for all this, the original owner, because the market prices in the expected costs. You get these 3, you'll be in great shape. So I'll just leave you with this final thought. If agency costs are just an unavoidable, fundamental part of people trying to work together, as real a cost as paying for labor or materials, then can any organization ever be truly efficient in that perfect textbook way? It's a deep question that challenges a lot of our basic assumptions. All right, now go crush that exam.